Why the 2026 financial collapse might be worse than 2008? In 2008, a crisis sparked by bad home loans brought the global economy to its knees. Today, hidden in plain sight, multiple red lights are flashing, signaling a potential crisis on a scale that could make 2008 look like a minor tremor. Now, I know what you're thinking. Mainstream experts are pointing to sturdy GDP growth forecasts from firms like Goldman Sachs, telling you everything is fine. They see a resilient economy. But they are ignoring the brutal undercurrents converging into a perfect storm, and the pressures are building toward 2026. In this video, I'll reveal the 4 converging crises that are creating a financial house of cards. I'm going to show you the shocking data that Wall Street hopes you overlook. And most importantly, I'll give you a step-by-step guide to protect your wealth. This isn't about fear, it's about preparation. Crisis number 1, the commercial real estate time bomb. The first crisis is a ticking time bomb buried in the heart of our cities, commercial real estate. In 2008, the problem was residential mortgages. In 2026, the fuse is lit on over a decade of cheap debt that financed office towers and shopping malls that are now facing a brutal reckoning. Here's the data the mainstream is downplaying. Between now and the end of 2026, a colossal wall of commercial real estate debt, hundreds of billions of dollars, is coming due for refinancing. This wouldn't be a huge problem in a normal environment, but this is not a normal environment. These loans were taken out when interest rates were near zero, around 3%. Today, property owners are staring down the barrel of refinancing at rates of 6%, 7%, or even higher. That's double the cost of borrowing. For a building that was barely profitable at 3%, a 6% rate can be a death sentence. At the same time, the value of these buildings is collapsing. The remote work revolution has gutted the office sector. National office vacancy rates have soared past 20%, with cities like San Francisco seeing a catastrophic 30% of their office space sitting empty. Property values in many markets have already plunged by 20% to 40%. This creates a fatal feedback loop. As property values fall, banks demand more money to refinance a loan, but owners don't have it because their asset is worth less. The result? Default. As we head into 2026, commercial real estate delinquencies are already spiking, with the office sector distress rate jumping to nearly 11%. And this is just the beginning. The real pain arrives as the bulk of that debt wall hits. So why does this matter if you don't own an office tower? Because unlike 2008, when the risk was concentrated in a few massive Wall Street banks, this crisis is spread across America's regional banking system. There are hundreds of small and mid-sized banks in the U.S. where commercial real estate loans make up a massive portion of their capital. These are the banks that provide loans for small businesses, for families buying cars, for the entire real economy to function. When these banks start to wobble, a credit crunch could spread across the country, choking off economic activity far more broadly than in 2008. Crisis number 2, the everything bubble has reached its limit. The commercial real estate crisis is just the first trigger. The second, and potentially more dangerous problem, is that we are living in one of the most overvalued stock markets in modern history. It's not just a bubble, it's an everything bubble, and the data is screaming a warning. First, let's look at the Shiller P/E ratio, which gives a clear picture of market valuation. Its historical average is around 17. Before the 1929 crash, it hit 30. Before the dot-com bust in 2000, it peaked at 44. In the run-up to 2026, the ratio has again reached heights that have historically preceded major market crashes. Second is the Buffett indicator, which compares the stock market's total value to the country's GDP. A reading of 100% is considered fair value. Anything over 160% is a historical sign of severe overvaluation. Today, that indicator is sitting at astronomical levels, higher even than during the dot-com bubble, suggesting stocks are fundamentally disconnected from the real economy. This overvaluation is driven by incredible market concentration. Just 7 companies, the Magnificent Seven, make up over 30% of the S&P 500's entire value. This is the most concentrated the market has been in decades, echoing the Nifty 50 bubble of the 1970s and the dot-com craze of 1999. In both cases, the market darlings everyone thought were invincible came crashing down, taking the whole market with them. The story today is that this time is different because of AI. We're told AI justifies these sky-high valuations, but in the 90s, the internet was also a world-changing technology, and it was. That didn't stop investors from losing their shirts paying fantasy prices for internet stocks. AI is transformative, but the market has priced in decades of flawless growth, leaving zero room for error. When this bubble pops, and they always do, the wealth destruction could be immense. A major correction isn't a matter of if, but when. Crisis number 3, the sovereign debt doom loop. You might be thinking, this sounds bad, but in 2008, the government just bailed everyone out. Won't they do it again? That brings us to the third crisis, the sovereign debt doom loop. In 2026, the cavalry isn't coming because the cavalry has its own problems. In 2008, the U.S. national debt was around $10 trillion. Today, it has exploded to nearly $38 trillion. The government is adding trillions in new debt each year, and there's no end in sight. This isn't a partisan issue, it's a math problem. The real crisis isn't just the debt level, but the cost of it. In fiscal year 2025, the interest payments on the national debt alone crossed the unthinkable threshold of $1 trillion. That is $1 trillion spent on nothing but interest, more than the entire defense budget. This is creating a terrifying feedback loop. The government has to borrow more money just to pay the interest on its existing debt, which pushes borrowing costs higher, which then makes the interest payments even larger. It's no wonder that ratings agencies have been publicly voicing concerns over the nation's deteriorating fiscal situation. Here's why this makes 2026 so much more dangerous than 2008. Back then, the Federal Reserve cut interest rates to 0, and the Treasury launched massive stimulus. They had the ammunition. Today, that ammunition is limited. The national debt is so high that another multi-trillion-dollar bailout is fiscally questionable. And with inflation still a concern, the Fed's hands are tied. They can't just slash rates to 0 without risking another painful surge in prices. So when the next crisis hits, the government will be a constrained spectator, not an all-powerful savior. Crisis number 4, the consumer is at a breaking point. The first 3 crises are the storm clouds on the horizon, but the 4th crisis is what brings it all home. It's the final domino. The American consumer is breaking. For years, the consumer has been the backbone of the U.S. economy. Fueled by stimulus, cheap debt, and savings, they kept spending. That era is definitively over. Let's look at the auto market, the canary in the coal mine for consumer health. Americans are buckling under a record $1.66 trillion in auto loan debt. Delinquencies on subprime auto loans, those given to the most vulnerable borrowers, have hit their highest level in decades. In 2024 alone, a shocking 1.73 million vehicles were repossessed, a number not seen since the 2008 crisis. To make matters worse, nearly 28% of people trading in a car are underwater, owing an average of almost $7,000 more than it's worth. It's the same story with credit cards. Total debt has soared past $1.2 trillion, with the average interest rate at a punishing 21%. The average household is now carrying over $11,000 in high-interest credit card debt just to make ends meet. Historically, people will do anything to keep their car. When you see auto defaults spiking to these levels, it's a scream for help. It signals that consumers have burned through their savings, maxed out their credit cards, and are now being forced to make impossible choices. This is the convergence. When the consumer finally pulls back on spending, it sends a shockwave into the same regional banks being crushed by commercial real estate. The stock market, priced for perfection, will have to confront a collapsing consumer base. And the government, buried under its own debt, will be limited in its response. This is not four separate problems. It is one interconnected systemic crisis waiting to happen. The solution, your 6-step wealth protection plan. Hearing all of this can feel overwhelming. It sounds dire and the risks are real. But this isn't a time for fear, it's a time for preparation. The greatest transfers of wealth happen during moments of crisis. Those who are unprepared get wiped out. Those who see the storm coming and adjust their sails not only survive, they can thrive. So what can you do? Here's a step-by-step guide for turning a crisis into an opportunity. Step 1, stress test your portfolio. Before you do anything, you need to know where you're vulnerable. Ask yourself a tough question. What would a 30% or 40% drop in the stock market do to my savings? If that number makes your stomach churn, you're carrying too much risk. This step alone will give you the clarity you need. Step 2, build liquidity. Cash is king. In a crisis, cash gives you options. Those who had cash in 2009 were able to buy assets for pennies on the dollar. Aim to have 12 to 24 months of living expenses in cash or cash equivalents, like a high-yield savings account. This cash is not just defense, it's your opportunity fund to use when panic is at its peak. Step 3, diversify geographically. The U.S. stock market is one of the most expensive in the world. Many international markets, by contrast, have much more attractive valuations. This doesn't make them immune, but it gives them a greater margin of safety. Consider allocating a portion of your portfolio to international stocks. Step 4, embrace hard assets. In an era where governments are creating money out of thin air, hard assets can be a crucial hedge. There's a reason central banks around the world have been buying gold at a record pace. They know it's a store of value outside the traditional system. An allocation to physical gold and silver, along with broad commodities, can provide critical protection. Step 5, monitor the triggers. You don't have to guess when the crisis will hit. Watch the data. Set alerts for yourself. When you see commercial real estate delinquencies or subprime auto defaults cross key thresholds, you'll know the storm is getting closer. Step 6, prepare your opportunistic buy list. A crisis is a terrible thing to waste. The time to decide what to buy is now, not in the middle of a panic. Identify high-quality, cash-rich companies that you would love to own at a 50% discount. History shows these are the companies that lead the market out of a downturn. Have your list ready. To summarize, we are facing 4 converging forces: a commercial real estate collapse threatening regional banks, a historically overvalued stock market, a government with limited ability to fight a recession, and a consumer at a breaking point. The combined force of these risks could create a financial event that makes 2008 feel like a distant memory. But remember, you cannot control the global economy, but you can control how you prepare. By understanding these risks and taking strategic action now, you can shield your family from the fallout and put yourself in a position of strength. Now I want to hear from you. Which of these 4 crises worries you the most? Let me know in the comments below. And if you found this analysis valuable, please hit the like button and subscribe. Thank you for watching.